Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to the markets here. So equities continue to roll over. Bond market, quite interesting. You had a sell-off right when those CPI numbers hit. You had a spike in the 2-year yield. And then once the cash market opened for the equity market, the bonds continued to really roll over with yields moving significantly lower now. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, it joins us. I shouldn't say significantly lower, but compared to where they were, it was quite a move. What are we making of the move today?
Yeah, so after the CPI report came out, the market was thinking, oh, well, maybe the Fed is less likely to do a 50 basis point rate cut next week, and so we're going to readjust that front end yields. Once the equity started to roll over, you also have seen a pretty big rally in European rates this morning, our time, and afternoon their time, and I think that Treasuries have a flight to quality bid from the risk off in the U.S. markets, but also are being pulled down a little bit by the global rate environment as well. So again, not huge moves on a day-on-day basis, but like you said, Alix, the fact that we were off by 6 basis points in 2-year yields, and then now we're essentially unchanged. I think that's meaningful enough that the market is not 100% sure right now, and certainly we're not priced for just the 25 basis point cut next week.
So, Ira, how do you think our friends at the Federal Reserve will read this inflation data today?
Yeah, so our view is that this solidified the idea that a 25 basis point rate cut is in the cards. Again, 50 is not impossible, and certainly the market doesn't think so either. But at the same time, a 0.2% inflation print is still above the Fed's target. So even though they want to cut interest rates because they're worried that the economy is starting to slip, and certainly they've been focused more on employment than inflation in recent months. That they can start a slow rate cut cycle. I know some houses on the street think that they could go 25 and then 50 basis points for a couple of meetings thereafter. I suspect at the end of the day they're going to go 25 basis points at every meeting. So the market maybe has gotten a little bit ahead of itself when you look at pricing for, say, January Fed funds futures or even 2-year yields for that matter.
Yeah, so it seemed like what happened is once we got the print that 50 basis point potential cut moved more to December rather than pricing it out. It just kind of pushed it off a little bit. Does that need to be pushed out even more, or is it just taken out altogether?
Well, I think as a base case, and the way that I'm thinking about how the economy might develop, and then what the Fed's reaction function, and therefore the Treasury market's reaction function to that new economic news, is that the economy is going to continue to slow, but not very quickly. So therefore, the Federal Reserve will be able to be patient and go in 25 basis point increments, and then maybe at some point it might do a 50. But I don't think that the Fed necessarily wants to, and certainly as a first, and we've been saying this for months now, is that if the Federal Reserve were to start with a 50 basis point rate cut, that would be like a shock and awe kind of event, and I think that would show the market and maybe just Main Street businesses and households that the Fed's panicked and they see something maybe that's much weaker than most of the economic data that's coming in suggests. So I think that would show some panic, and that's another reason to think, hey, they'll go 25s unless and until you wind up having negative payroll print or even $50,000 person payroll print would be enough for them to say, hey, the economy's not growing anywhere near potential, so we really have to cut interest rates significantly. But until we get to that point in the data, I think that the Fed's going to go 25 basis points. And look, this is all like short-term interest rate trader minutia, quite frankly. And I think for the broader markets, you have to say, okay, the Fed's in easing mode. The question is how fast and how far, not necessarily are they going to be cutting rates.
Ira, about 30 seconds left here. The election, the Treasury market. I don't think I heard the yield curve mentioned last night at the debate, but how do you guys frame out kind of the political risks here?
Yeah, so we put out our we put out a note on what we thought the big impactful things for the Treasury market will be based on the election. Most of those are not expecting a big reaction on election day one way or the other, but nuanced things like who's the next Fed chair going to be. That's going to matter. If President Trump wins election again, it won't be Powell. Maybe for Kamala Harris, it will be Powell, and if not, it will probably be someone else who was maybe a Biden appointee to the Fed. So those are the types of things that matter, and then of course things like budget deficits. Those neither of these candidates is likely to be a deficit hawk, so therefore you're likely to continue with relatively large budget deficits, and that obviously has an effect on pricing in the Treasury market.
Ira, always a pleasure. Always great to catch up with you. Ira Jersey joining us. He is Bloomberg Intelligence Senior U.S. Interest Rate Strategist.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we got through the risk events. We got through the debate. We got through CPI. We're headed towards the Fed. It looks like markets are now pricing in that 25 basis points in September. So what do you do in that scenario? Nicole Webb, Senior Vice President, Financial Advisor at Wealth Enhancement Group, and she joins us now. Nicole, does this take 50 off the table, or does it push the 50 out to like a November or a December?
You know, we were of the camp that the Fed probably wasn't going to step into this cutting cycle with 50 basis point cut. And so for us, the CPI today was largely in line with expectations, obviously across the board. And for us, it just didn't bear terribly much weight in the short term.
So what are the key drivers here then, do you think, of these markets going forward? Again, as Alix was just mentioning, we've gotten through a number of kind of external events here. What do you look to be kind of a driver for markets going forward?
Yeah, Paul, I think, the market response over the last couple of weeks has really been, and I would say even maybe this is some of what you're seeing this morning after the CPI, which, as I just mentioned, was largely in line, but it's this need for all of the fundamentals to hold up in support of equities. And so when you think of part of that being the disinflation story, part of that being the release of the pressure valve on the consumer, and then also you layer in the need for policy to go the right direction, corporate earnings, to continue to perform. It really just puts a lot of weight on the market where you have valuations high, consensus long equity, and then you also have a cooling economy, not just here, but also globally. And so it's just going to be a lot of digestion we expect over the next couple of weeks, if not months.
Yeah, talking about globally, I was talking to an oil trader today, and he was at a conference over in Singapore. Yeah, I know, it's a shocker. And he was saying that everyone used to think that China was just going to be a property issue, and now everyone, even the Chinese, are like, oh, no, this is a real broader economic problem in China, just to talk about the weaknesses there. So what's the playbook, Nicole?
Yeah, I think when you have a market that's digesting, to your point, Alix, the why, it begs the question, why are we slowing? And then does it change? And China's not a quick reversal, so that likely isn't changing in the short term. And we know that they're greater than 15% of global GDP. That has a big ripple effect. And then you think of the restrictive policy landscape in the U.S., even a normalization of rates, to your point about not knowing exactly what that neutral rate is, it's going to take some time. And then you have excess savings declining. And so the last leg of that then being my fourth point, which is all doesn't sound overly optimistic, but you have the deceleration of earnings from the mega technology companies as they continue to increase that cap spend. And so when you think then about where we're going to invest money, still under this long bull thesis, we really are looking for places where you can expect earnings acceleration forward looking, where it's an environment that isn't necessarily in demand of global growth accelerating, but instead, if we normalize or we're okay with on trend, what are those pockets? And so you're already hearing this a lot, that healthcare pocket, utilities pocket, the REIT pocket, all of that bodes favorably in the forward-looking landscape over the next 6 months.
Yesterday we had some big moves into the downside for some banking stocks led by J.P. Morgan, and J.P. Morgan's weak again today. So I guess calling into question a lot of industry leaders at a recent conference about the profitability for the upcoming quarter for the banks. How do you think about the financials as a whole here?
Yeah, I think first when we think about the banks, we have to remember that it was only a couple of weeks ago that we were at fresh 52-week high on bank stocks. And so, that in and of itself, again, going back to kind of where we are from a valuation and consensus perspective, the conversation around NII, it's expected to deteriorate. So the response there to some of the comments yesterday was, again, kind of to be expected and perhaps shouldn't have been new news. And then again, curiosity around, even though we were talking about delinquencies, there has been a consistent flatlining to delinquencies. We're not seeing an acceleration in growth in delinquency. And so again, I think this goes back to where I kicked things off today, which is that we need a lot of fundamentals to stay in support of equities, and anything that looks like it's a deterioration of any of those fundamentals when you do have valuations as high as they are is going to put pressure both on sectors and on the index as a whole.
Decline.
Yep.
That speed of that decline was really confusing. Like we knew it was going to be happening with rates, which was just so odd. Tech last 2 days has been the quote unquote outperformer. That's safety trade, if I can say that, right? You had the bid into bonds yesterday. You had the dollar moving higher as well, and you had that bid into tech. Is tech going to be that safety rotation trade?
It's hard when you see pullbacks in the tech area where, we've been talking now for a few weeks that they were no longer the leader for calendar year 2024. That does look like an opportunity to be a buyer in that space. Yes, we don't know in the short term what that return on invested capital is or how quickly we start to see those earnings surprises to the upside on that investment made. But if you have a long thesis, if you are a long-term investor, not a trader, these pullbacks do look like a time to deploy fresh money into that sector.
Fixed income here. We've had yields pull in pretty dramatically. Just on the 10-year, we've gone from 5% to now today around 3.6% here. What are you doing in fixed income space? Are you taking credit risk?
Yeah, when it comes to fixed income, I think probably the thing that we have spent the most time on recently is just, are you almost better off on a 1 year staying in a money market? So if you don't believe there's going to be an acceleration to cooling and that the Fed doesn't necessarily have to go into a rate cutting cycle as we think of it traditionally, but more into kind of this shaving rates down as we normalize the interest rate environment, on a 12-month forward, could you actually outperform a 1 year treasury sitting in a money market? And so there's kind of some of this playing around, but fixed income we do think is going to continue to be a really valuable part of the portfolio. And we also expect to see a lot of flows into that sector. When you think just about where the concentration of wealth is in this country and the ages, it seems like a period in time in which you're going to see flows start to move away from some of that shorter duration investment into some of these longer, including credit exposure areas of fixed income. And so from a flows perspective, also, we think that will be favorable.
It's interesting, Paul. JP Morgan talked about how you won't see the money move from money market funds until the Fed starts cutting more aggressively, like until they're deeper into the rate cutting cycle. So we're all like waiting for that rush. We might have to wait a little bit until that happens. For you, what's the next catalyst? Is it just going to be the Fed meeting, or is there something else that you're looking at?
Yeah, to us, the first catalyst, Alex, to your point, would be, post-Fed meeting and is the dot plot. So what do we see, from members in terms of the trajectory of the rate cutting cycle we're entering? So if it is our first cut, what does that look like, on the next 12 months? And I think even more importantly is how the Fed speaks about the economy following the meeting. And what I mean by that is there's so much weight right now on, is it 25, is it 50, is the second cut 50 basis points? And a lot of that has to come from how they talk about the setup of the economy beneath these cuts. And I think there will be a big fear response if, they aggressively start cutting, which really does signal that we are far too restrictive and the economy requires stimulation versus we're on a trajectory of normalization. And so, that piece of it. And then the response from the housing sector in accordance to how the cuts go. We know we're under supply in housing. That's a huge catalyst for expansion in the markets if we do start to see a drive towards equilibrium in supply versus ongoing demand for housing. And so those two things have a pretty high correlation, we expect, and will handle the sentiment of investors as we enter the end of the year.
Very good. Nicole Webb, thank you so much for joining us. Nicole Webb, Senior Vice President, Financial Advisor with Wealth Enhancement Group, joining us from New York via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now is Henrietta Treyz, a managing partner and director of economic policy at Veda Partners. She's joining us. She's in New Orleans, actually. So, hey, just real quick, are you safe? Is it okay? Is the storm coming? Are you bracing for it?
Probably right when I get off here. It'll come just at the end of this interview. It's expected to hit tonight, but it won't be too much of a big deal. So I'm not surprised that oil stocks aren't moving too much. We're used to this. This is what we prepare for.
Okay, fair enough. All right, so we got that part done. Clearly, you were up late watching the debate with the spin and all the like. What's your pitch? What's your 1 minute, 2-sentence takeaway?
I think that Harris clearly ran away with the debate. Trump missed a number of opportunities to stick to a script and stick to policy. And I think that was a mistake for him. And he could potentially have to correct it with a second debate. I doubt one will take place. But if the polling data starts to turn against him, as Kamala Harris's sort of appeals to moderate voters last night, should that work, he may have to commit to another debate.
Henry, I'm just reading through your notes here, and you make a point here. About 95% of the electorate has already decided how they'll vote in November. Did I read that right? And if so, is that normal or is that crazy?
Almost everybody has decided how they're going to vote. There's only about 5% of the electorate that's undecided right now. They're not, they're actively trying to ignore politics, but they're going to engage post-debate. They're going to see clips from last night and start to make a call. There was, interestingly, 14% of viewers last night thought that they maybe questioned their priors. They thought they might, be willing to change, but then ultimately only 4% of them did. So we have a really sticky, very partisan America, and that's going to make this election close until the very end.
What do you think can move the needle now? In some ways, this was the public's first introduction to Vice President Kamala Harris. President Trump is still a known quantity, but nonetheless, how do they then further this if there's no second debate?
Right. 23% of Americans are still looking to learn more about Kamala Harris's policies. Most of Americans already know all of Donald Trump's policies. So the real uphill battle is on Kamala Harris's side. Right now, as my odds suggest, Trump is winning this race. The Electoral College favors him in most swing states and within the margin of error in every single swing state. So it's really up to Harris to convey her homebuyer tax credit, her position on abortion, her thoughts on capital gains rates, corporate tax rates, and sell that message to the American public. And I would suggest that the onus is on her to get that done.
Just on Bloomberg Radio and Television, Henrietta, just before we came to you, we were listening to Cantor Fitzgerald CEO Howard Lutnick, who is a strong Trump supporter, make the point that we've heard from a lot of folks that VP Harris should be more accessible to the media, should do interviews, should do town halls, press conferences. What do you think about that?
I'm sure that she will. As we go forward, the next major event is not until October 1st with the vice presidential debate. I think there's, 20 some odd days between now and then for the Harris campaign to take, a sit down with a major editorial board and do more live town halls. What I think Republicans want to see is her stand alone as opposed to with Tim Walz, which is, of course, what the interview with Dana Bash on CNN was a few weeks back. So I expect that she'll get out there. And the fact that American voters want to know more about her policies means that it is in her best interest to do that as well.
What I also was noticing when I was reading a lot of takes on independents who just weren't clear is that a lot of them are the people who go to the store, buy stuff, come home, and it's rough, and economically it's really hard, and that the debate last night didn't speak to that inflation or the economics. And you take a look at the inflation data today, right? It's kind of a mixed bag for everyone, but some of those core things like eggs are still a lot higher, and those prices are still a lot higher. How do the candidates really tackle that in a meaningful way where people who are truly undecided can get some clarity?
This is why debates are so important for the challenger or the other candidate, in this case, Donald Trump, to really hold her feet to the fire and say, answer these questions, speak to inflation. And Harris has, to her credit, they will have a great track record to say it was 7, 8, 9% 2 years ago, and now it's down to under 3%. So there is a message that can be delivered from both sides, but they just weren't sticking to that script last night. Another reason why I think Trump would benefit from a second debate is because he could hammer those points home, which he should have done last night. I do think also, just to speak to the inflation data, gas prices still being low, to bring it back to the beginning of our conversation, is really important here. Gas prices factor into the American psyche, I would say, more than the price of eggs. So that being low, I think, does help Harris.
So what is the role of the vice president candidates here? Do they move the needle at all on a major election?
I mean, usually not. It's a much smaller audience that watches a vice presidential debate. They're not viewed as the leader of the country. We used to say that it's, the least or the most thankless job in D.C. Obviously, Kamala Harris and Joe Biden's dynamic this year upended all of that. But in general, the vice presidential debate is not a blockbuster affair. They're usually pretty sleepy. In fact, and a couple of cycles in the past few presidential election cycles, you get fewer than 50 million or even 30 million viewers.
October surprise, it does happen. Could there be one now? Like, let's look ahead. If there's not another debate, everyone wants Kamala Harris to speak more. What could an October surprise be?
I think it would be ridiculous for anybody in a seat like mine to say that there won't be an October surprise in a year like this. I think at this point, what I try to hone in on for investors is that it could very easily be foreign policy related. Israel-Gaza, I think, presents a stark opportunity for some sort of shock event that could be a problem, particularly for the Harris campaign, since Joe Biden is the incumbent. I think the immigration data, the numbers have come down so rapidly since December via executive order. I don't see that changing. A government shutdown is probably something that should be on people's radar. Trump tweeted about this last night, supporting a government shutdown. That could be disruptive, but historically Republicans get blamed for that. So I don't think it's in his best interest.
30 seconds, Henrietta. Taylor Swift endorsement. Does that mean anything?
I think it does. We want to see his voter registration spikes, particularly in the 29 and under demographic. We've already seen that go through the roof. I believe it's 87% hiked up since 2020. And of course, you have 3 times higher registration rates for Black women, 147 for Latino women, and I think 87% is the number for all women. So that registration spike is what you'd want to watch.
All right, Henrietta, thank you so much. We appreciate that. Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners, joining us via Zoom from Louisiana, again, in the path of that incoming hurricane. So hopefully, Henrietta and all the good folks down in that part of the world stay safe over the next 24 hours.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. As Charlie was just reporting, we've got some selling in the stock market here today, perhaps on the back of a little bit higher than expected core inflation. Let's check in with a professional here. Kim Forrest, founder and chief investment officer of Bokeh Capital Partners, joining us from Pittsburgh, PA, via that Zoom thing. Again, more technology. How about that? Kim, thanks so much for joining us here. What do you make of today's trading here? And maybe the last two or 3 days of trading, been a lot of volatility.
Sure. Yeah, I think, as always, investors are pulled between the two poles of fear and greed, right? And I think this year has taught us that even with ho-hum kind of economic data, that the market can go higher. And I think that is what keeps the greed into the market right now, is that we look at our recent past and say, hey, Nvidia eclipsed all other stocks and then dragged 6 other stocks with them, starting somewhere in the second quarter. And, portfolios turned out pretty good. But I guess wisely, people are looking at the Fed and saying, are they too late? We know they're going to lower interest rates. That's pretty clear. But how much and how fast? And I think too fast would indicate that the Fed is seeing trouble ahead on either one of its mandates that it's supposed to take care of, and that would be stable prices and full employment. So, which you put those two together, you have the whole economy, right? What else is there in the economy? But no, investors are afraid that the Fed is too late, too slow, and that we're going to get a hard landing. Mm-hmm. Now, as somebody who has seen a hard landing, in 1993, Pittsburgh had a 17% unemployment rate because of inflation and the steel market being forever changed. And I don't think we are headed for that kind of hard landing, just to set expectations.
So, Kim, I hear you. And then I look at what's happening with bank stocks, and I'm confused. I mean, regional banks are getting really hit. Broader big banks also getting really hit by news that we already knew, right? Like we knew that rates were coming down. And in theory, if they come down less quickly, that should be better for their net interest income, right? So are banks telling us something else right now?
Well, I think they're really concerned about the consumer and borrowing, and specifically consumer borrowing. I don't know that regional banks would be all that much affected by it. It's usually credit cards. And I don't think that would see a whole lot of, housing issues, because most of the borrowers have very low interest rates, and the most recent borrowers, they're as everybody's been pointing out, the housing market is slowing and has slowed. So I'm not quite sure why the smaller banks are being sold off. Maybe it's continuing commercial real estate issues, of which, nobody can pretend that they're not there. We don't go to work 5 days a week anymore. You need less footprint. It's an issue, and it's something that remains unresolved.
So Morgan Stanley's Mike Wilson saying that the AI trade may be fading here in this market, and calls into question what will be the leadership for this market. How do you feel about that thought there?
Sure. Well, I think it's a pretty good bet that most investors have overplayed their hand on the timeline of AI rollout and how deep and pervasive it is. As somebody that is an ex-technologist in AI, I don't see the killer app that are going to make corporations, and certainly not individuals, pay for access to it. So right now it's a free service. But that could change in the future. It's probably going to change in the future, but we don't know how long of a timeline. Wall Street wants it yesterday, not tomorrow. So, and it's a pretty many tomorrows in the future where we think AI is going to be a player. But you're right. Where is the next area? I would say that investors that need to put money to work, and we all do because we're saving in our 401ks, they should look at the smaller companies, the unloved companies that have good products. And I love the medium-sized companies over $1 billion to maybe like 20 billion, because especially if they have great products and a stable balance sheet, they are able to live on through tough times, but also they are acquisition candidates. And as rates come down, we will see more mergers and acquisitions, because the big need to have new products or the product, growth. So they will do it either organically or by acquisition. And I think it's a pretty good idea to look at smaller companies, but not the smallest companies, for addition to your portfolio.
Okay, so the question, where do you buy the dip?
Where do you buy the dip? Well, that's market timing, isn't it? And I think we're all warned about that. So I think it's on a case-by-case basis that you have to look at each company and say, is this a good deal? If it goes 10% lower, am I going to be angry about having bought it, right? Give yourself some kind of wiggle room and understand that companies can go lower on all sorts of news. So I think you have to do it on a case-by-case basis. And, this wasn't in my note to you guys earlier, but maybe energy is an area as well. It seems to be especially selling off hard. And I would certainly put energy, as even bigger companies, as well as the small to medium-sized companies on your list, on your shopping list, and look at them daily and say, is today the day I'm going to buy whatever it is? It is that simple.
Kim, how about valuation? Obviously, it's important when, in the securities business that you're in, but how do you employ valuation? How high is it on your list of, decision factors for buying or selling a security?
Well, actually, I don't look at it in isolation, right? I'm a growth-ish manager. I'm growth at a reasonable price. Yep. So I'm always thinking that the company that I'm going to buy is going to grow, and it will grow more into its valuation. So I will look at PEs that other value-oriented managers probably will not. But that being said, you also have to understand in a declining rate environment, you should expect to pay a higher PE, and that's because of the math behind the whole discounted cash flow equation, which we're not going to go into at this point. But I also think it's extremely important not to look at them in isolation, but to their competitors and to their industry, because each industry has a different PE profile where it's merited. Because the balance sheets are completely different, right? Like a software company is different than, I don't know, a cement making or a steel making company that has a lot of plant, property, and equipment. So those are the kind of things that change your perception of a PE, whether it's rich or fairly valued.
And this is a great setup into talking about last night's debate, because from the way you invest in stocks and how you look at structural trends, even in cyclical areas of the market, how do you think about who's going to be running the White House over 4 years? Like, what are there areas that actually impacts how Kim Forrest looks at the market?
Well, it does, but slowly, because okay. I don't know, I have this quaint idea that the president, regardless of who it is, actually is the executive of the government, and that Congress gives them a budget. So things like, I don't know, housing grants of $25,000, that still has to go through a Congress. And that is a very slow process. So I am glacial, and I try to look for bigger trends that eclipse politics. So I'm not terribly concerned about what's going to happen other than taxation. Taxation is one of those things that can come in fast. But any of the more spending of the government and areas in which they spend, it's more glacial than we ever want to consider.
All right, Kim, thank you so much for joining us. Kim Forrest, founder and chief investment officer of Bokeh Capital Partners from Pittsburgh, PA.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. The headline that truly caught my eye today was UniCredit finally making a move on Commerzbank. This is something that I've heard rumors about for years. And UniCredit building a 9% stake in the German bank, and apparently is planned to enter into talks with the lender, raising the possibility of a takeover that could truly reshape Europe's banking landscape. Joining us now from more is Philip Richards, Bloomberg Intelligence Senior Analyst for European banks. Philip, would the German government let this happen?
Yeah, hi there. It's an interesting one. As you say, this is not a new rumored deal. It's been going on for literally well over a decade now in terms of big cross-border deals. But the simple case remains that any big cross-border transaction among European banks still hasn't happened in the last 15 years since the crisis. So will it happen now? Yes, it's a possibility, but there's still a lot of hurdles left. In terms of will the German government allow them specifically, what it would flag is the German market is very different to all the other European markets. It's got a very big cooperative or mutual society compared to, they've got the Sparkassen, the Landesbanks. So actually the private banks, Deutsche Bank and Commerzbank, are a much smaller part of the overall market. And therefore, could they take out the second biggest German bank? I think it is possible on that front.
Would it be a good deal for UniCredit? I guess what I'm asking is, how good of a management team, how good of a franchise is UniCredit?
Well, is it a good deal? I mean, that will come down to the price. And one good thing about Commerzbank is pricing is at a very low level. Even after rallying 20% about today, it's still trading about half book value. In terms of what you get for it, yes, the earnings have been very, very weak for the last 15 years, one of the lowest return on equity of all banks in Europe, but they have increased massively with rate rises across Europe. But of course, the flip side to that, of course, is interest rates now going down. So the question becomes, what will happen to Commerzbank's earnings going forward? And frankly, they're probably going to be going down, and therefore that's where the pressure on them will lie. So are they getting a good deal, or are they paying almost at the top in terms of their earning potential?
What company would that make UniCredit? Like, would this be a giant investment bank and a giant retail bank?
Well, they will become the third largest European bank if they did the deal in terms of a market cap basis. Obviously, Commerzbank is almost entirely now a retail and commercial bank. It sold all the investment banking operations it had after the financial crisis. So this is very much a case of expanding in terms of that retail commercial space. UniCredit have a big presence in Germany already through Hypervereins Bank. So one of the attractions to the deal for them would be combining that, say, Commerzbank and Hypervereins, and therefore trying to get the cost synergies out of them. But say it's very much on the commercial retail side rather than investment banking. So,
Philip, talk to us about, just the German banking market right now in general from a competitive landscape. Does there need to be consolidation?
Does say yes. It's probably the least consolidated market in Europe in terms of, as you said, you've got this huge number of cooperative banks, the Sparkassen, etc. So it is a very difficult and diluted market. But the fact is, Commerzbank itself has got a sub 10% market share. So even if UniCredit did buy it and combine Hypervereins with them, they're still probably just getting over about that 10% mark. So will it change the dial in Germany? Not at all, because we're only talking in a 30% subsector in terms of the private banks, with 70% or so of the market, is in this mutual side.
So you were talking earlier that this has been a rumor for 10 years. I remember talking about this at least 6+ years ago. Also, why do you think that now could be actually the moment?
Well, you asked us about what they get in terms of Commerzbank. We heard last night, actually, the CEO of Commerzbank said he will not renew his tenure, which expires at the end of next year. So, that does open a hole at the top of the bank, which obviously be an attraction for them. So that's one potential way of doing it. Who would have bought Commerzbank given the excessive risks they had, say, 3-4 years ago, where we had, say, commercial real estate risks. We had the bank trading at 0.3 times book value. We had earnings are very, very low. So in a way, the risk has gone away a lot of Commerzbank because because the earnings are much stronger now because of those rate rises. Also, the German German government took a big stake in the bank. So as they sell that further and further down, that's part of the way UniCredit built their stake today. That obviously becomes more and more attractive because it comes more into the private sector. So there are a number of small reasons why it could happen, but does it mean anything will happen? Then no.
Is this going to ignite maybe a little bit more discussion about more cross M&A trades, just broadly defined across Europe?
Without any doubt, it will trigger more M&A speculation today. And I think the fact that you say they build a 10% stake and yet the shares then rally 20% shows that the market doesn't think this is the end of the story. And there's going to be more of a deal and the potential bid for Commerzbank is possible. That said, why has there been no big M&A across the sector now for 15 years? And because a number of the regulatory hurdles remain. There's not a single rule book across Europe. Government interference, people don't want to leave their biggest banks and be taken over by a foreign institution, etc. All these hurdles, and nothing's actually changed on that front. That's all still the same today. So, no big deals have happened. Could this be the first? Yes, but it's by no means certain it will.
30 seconds. If the deal does happen, would the bank be able to lend more and do stuff?
I think I would have said yes 3 years ago, just because of the weaker financial position that Commerzbank was in. I think because of the rate hikes now, is in a much stronger position. It's got a surplus capital position itself. So there's no real barriers in terms of the supply side, their potential to lend more. What's restraining them from growing is actually more the weaker German economy. And we're hearing more about that over the press in the last few days. And that's what's been holding them back. And frankly, nothing changes with this UniCredit deal there. Those hurdles still remain. So no, I don't think this will really help in terms of the lending or the growth potential. It's much more, I think, about the synergies in terms of the cost takeout potential.
So maybe that, like the framing of the deal, could have changed versus like 6 years ago. All right, thanks a lot. Philip Richards, Bloomberg Intelligence Senior Analyst for European banks, on that 9% stake that UniCredit now has in Commerzbank.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.